Today, this crypto winter may not turn to spring. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and prop news with a distinctively Australian flavour. Well, those following my channel over recent years will know that I've been quite sceptical of the crypto wave. And while crypto has gone through several major drops in its history, this time it could be different. I was not impressed with the so-called celebrities starting to spruik cryptos, including Kim Kardashian. And when financial mainstream started to get involved, my concerns grew. And of course, in the US, Fidelity's plans to offer Bitcoin in the 401ks, their equivalent of superannuation, well, that could impact an entire generation. Now, it's worth recalling the sector spiked to around $3 trillion in total assets last November before plunging to less than $1 trillion, with Bitcoin and a range of altcoins plunging from record highs. And what started this year in crypto markets as a risk-off bout of selling, which was fueled by the Federal Reserve suddenly determining to rein in the question of inflation, the truth is that a web of interconnectivitedness that looks a little like the tangle of the derivatives that brought down the global financial system in 2008 is now emerging. The collapse of the Terra ecosystem, a much hyped experiment in decentralized finance, began with its algorithmic stablecoin losing its peg to the US dollar and ended with a bank run that made $40 billion of tokens virtually worthless. Crypto collateral that seemed valuable enough to support loans one day became deeply discounted or illiquid, putting the fates of a previously invincible hedge fund and several high-profile lenders in doubt. The recent crypto plunge, with Bitcoin down around 70% from its peak, is fueling widespread financial troubles for companies involved in the space. Lenders like Celsius Network, Babel Finance and Vauld have suspended withdrawals, while firms such as Coinbase are cutting jobs. This is what is now being called a crypto winter. But my question is, will spring ever come? Crypto collateral became deeply discounted or illiquid, and some are starting to draw parallels with the global financial crisis and Bear Stearns, which marked the turning point back in 2007. A broad-based sell-off in digital assets has certainly led to a liquidity crunch, again, just like 2007. And the news this week was bad, very, very bad for crypto believers who are having to navigate liquidations, withdrawal freezes, trading halts, and at least in one case, a bailout. And many who cannot afford to lose hard-earned savings will probably do so. Last Friday, crypto broker Voyager Digital announced a suspension of trading, deposits and withdrawals. Account holders shouldn't expect to get all the crypto back. As the company reorganizes, Voyager doesn't intend to simply give users back their Bitcoin, Ether and other assets stored on the platform. This beleaguered crypto brokerage and lender filed for Chapter 11 bankruptcy last Tuesday, renewing unresolved legal questions about how digital assets will interact with US insolvency law. The company's plan to exit bankruptcy plainly says it expects account holders to be, quote, impaired by the Chapter 11 process, meaning they won't be getting back exactly what they owned. Voyager intends to repay users with a mix of the crypto they deposited, stock in the restructured company, Voyager tokens, and money recovered from bankrupt hedge fund Three Arrows Capital, according to the court papers. Three Arrows owes Voyager more than $650 million. And customers with US dollar deposits in their accounts will be able to reclaim that money, quote, after a reconciliation and fraud prevention process is completed with Metropolitan and Commercial Bank, according to a statement from Voyager. Voyager doesn't keep user assets in designated wallets for each customer. It instead mixes deposited crypto into asset-specific pots, just like the ones for Bitcoin and Ether, according to the papers. And the company has about $1.3 billion of crypto assets on its platform, it said in the statement. And Voyager also lends deposits to third parties to pay interest to customers, a dynamic that users agree to when they sign up for the platform. And several billionaire investors, including Sam Bankman-Fried's Alameda Research, Mike Nodegrat's Galaxy Digital, and Wintermute Trading, are among those who owed Voyager on account of crypto loans as of its bankruptcy filing. Now, another player in trouble, BlockFi, a major digital asset lender, won the backing of exchange FTX US with the potential to be acquired. In fact, both companies were really upended by the woes of Three Arrows Capital Limited, a beleaguered crypto hedge fund that was ordered for liquidation by the British Virgin Islands court this week and filed for Chapter 15 bankruptcy protection in New York. Three Arrows Capital was a crypto hedge fund that bet big on everything from Bitcoin to the ill-fated Luna tokens and then succumbed to the $2 trillion wipeout of the digital assets market. Three Arrows had invested in a range of decentralized finance platforms such as Aave and DYDX, as well as crypto infrastructure firms such as Starkware. And the court, which made the order last Monday, has appointed two partners at consulting advisory firm Teneo to handle the liquidation. They will oversee talks with potential buyers that may be interested in Three Arrows' remaining holdings, such as tokens or equity stakes in crypto startups. And a website will be set up, they say, to locate creditors and determine who's owed what, according to its website. Now, it's not immediately clear what or how much of those holdings will be subject to a sale. And the court order brings down the curtains on one of crypto's most famous hedge funds, founded by Zhu and Carl Davis, former Credit Suisse traders, at the kitchen table of their apartment in 2012. Their fortune rose along with the crypto market bull run, and 3 Arrows' assets under management were estimated to be around $10 billion in March, according to blockchain analytics firm Nason. And in April, Zhu said the fund was planning to move its headquarters to Dubai from Singapore. Three Arrows has been emblematic of the industry's excesses during last year's bull run, when firms built up the leverage that held them as the market turned. This month, a cryptic tweet from Zhu hinted at Three Arrows' reversal of fortune and growing plight, setting off a market spasm. The liquidation of Three Arrows will present a setback to the industry's policy efforts and ongoing engagement in DC, said Ryan Selkis, co-founder of Messari Inc., a crypto data and research platform. Many of the centralized institutional lenders in the space had poor risk controls and put customers' funds at risk. The fund's liquidity crunch is among a series of crises that rippled through the battered crypto sector during this year's downturn, including the implosion of the Terra USD stablecoin and liquidity issues at lenders Celsius Network and Babel Finance. Three Arrows' woes, of course, have hit firms such as crypto broker Voyager Digital, as I discussed, which this week issued a notice of default to Three Arrows after failing to get repayment on the loan worth around $675 million. An earlier crypto lender, BlockFi, and prime brokerage Genesis said they had to liquidate one of their large counterparties recently without naming the counterparty. Three Arrows Fund was incorporated in the British Virgin Islands, and the commercial court there orders a company to be liquidated if it is regarded as insolvent because it cannot pay its debts. Companies can also voluntarily liquidate, though that's less common. I had begun to think that dominoes had stopped falling in mid-June, said Aaron Brown, a crypto investor and Bloomberg opinion contributor. I suspect by Tuesday morning there will be more bad news, although I make no specific predictions. The fuller extent of their impact on the industry, though, is starting to emerge. Blockchain.com and Deribit, a crypto derivatives exchange, this week confirmed that they were among creditors that sought for the liquidation of Three Arrows. And a spokesperson with Blockchain.com said it also was cooperating with ongoing investigations into activities by Three Arrows, which has been reprimanded by Singapore Central Bank over false information. Crypto is a nascent industry, but intense competition developed among service providers vying for the business of a small set of entirely new counterparties, said Alex Felix, managing partner at Coin Fund. Kai Samaya, co-founder and managing partner at Multicoin Capital, said there is a need for appropriate regulations and transparency, and that an industry coalition should come together to protect retail consumers. Voyager's chief executive officer, Stephen Everick, said it needs additional time to explore strategic alternatives, something that Celsius Network, which has also halted withdrawals, has been pursuing. Sang Bankman-Fried, who has acted as a lender of last resort for the industry, earlier turned down a bailout request by Celsius, according to a number of sources. This was a tremendously difficult decision, but we believe it is the right one, given current market conditions, said Eric in a statement. Voyager plunged by as much as 43% in US trading on Friday, making it one of the worst performing crypto stocks. And based in New York, Voyager offers crypto trading, staking, that's a way of earning rewards for holding certain cryptocurrencies, and yield products. And last month, Voyager issued a notice to default to 3 Arrows on that loan. It's actively pursuing a recovery from the crypto hedge fund, including through the court-ordered liquidation process in the British Virgin Islands. And it has received a credit line from Alameda Research, Bankman-Fried's trading firm. Now, of course, crypto traders often shrug off steep losses, arguing they're holding for the long term and they expect prices to rebound. Yet for investors who trusted Voyager with their retirement savings, down payments and emergency cash, the prospect that their investments may be gone forever is a real wake-up call for those who believe large trading platforms offered a form of security. This type of downside risk can be pretty brutal, said Mike Bailey, Director of Research at FBB Capital Partners. In some ways, when investors suffer these kinds of losses, similar to when a bond goes to zero, it can feel like the system is broken. In this case, investors may believe an impression that the system has failed, leading to a desire to exit. Crypto traders who can still pull their money off platforms are doing so quickly. The total balances on exchanges have fallen by more than 20% from a January 20th high, according to Glassnode. And meanwhile, on-chain activity for Bitcoin has dropped 13% in early July from the peak in November. Now, I know of people who invested their savings in coins such as Bitcoin, Ether, and Dogecoin, along with some stable coins. Their plan was to build a deposit for a house, but of course the values have plummeted, putting their futures at risk. Now, some true believers say, stay the course, things will get better, but will prices recover this time around? For many crypto traders, watching the value of their holdings fall, at least occasionally, is to be expected, but losing that investment altogether is almost unfathomable. It's so easy to get lulled in, but you have to read the small print. The sociology is actually interesting here. For a generation of alienated techies, crypto's all for one ethos was its biggest draw outside the system: personal control, a sure bet. But now panic is spreading across this universe, and that same ethos is posing on what may be the biggest threat yet to its survival. The seeds that spawn the meltdown, greed, overuse of leverage, a dogmatic belief in numbers can only go up, aren't anything new. They've been present in virtually every asset bubble, including real estate. But in crypto, and particularly at this time, they are landing in a new and still largely unregulated industry all at once, with boundaries blurred and fail-safes weakened by a conviction that everyone involved could get rich together. There are a few founders who may have already made a profit and have gotten out, but a lot of small people are now caught in the crossfire. Now, of course, crypto has gone through several major drops in its history, known by those in the know as crypto winters, and to the rest of finance as a bear market. But the market's expansion and increasing adoption from Main Street to Wall Street means now more is at stake. It's got a different flavor this time, Jason Urban, co-head of trading at Galaxy Digital, said in an interview. Galaxy, the $2 billion digital asset brokerage founded by billionaire Mike Novogratz, benefited immensely from crypto's rise, but was also one of the industry's most prominent investors in the Terra experiment. Truthfully, it's being a victim of your own success. In 2022, the downturn looks far more like a traditional finance deleveraging, said Lex Solikin, global fintech co-head at Consensus. All the words that people use, like a run on the bank or insolvent, are the same that you would apply to a functioning but overheated traditional finance sector. Consumer confidence and perception of bad actors definitely played a role in both cases, but what is happening now is about money moving out of deployed, functional systems due to over-leverage and poor risk-taking. In bullish periods, leverage is a way for investors to make bigger profits with less cash, but when the market tanks, those positions quickly unwind. And because it's crypto, such bets usually involve more than one kind of asset, making contagion across the market even more likely to occur. Crypto loans, particularly those in decentralized finance apps that dispense with intermediaries like banks, often require borrowers to put up more collateral than the loan is worth, given the risk of accepting such assets. But when market prices sour, loans that were once over-collateralized suddenly become at risk of liquidation, a process that often happens automatically in DeFi and has been exacerbated by the rise of traders and bots hunting for ways to make a quick buck. John Griffin, a finance professor at University of Texas in Austin, said the rise of crypto prices last year was likely fueled by leverage speculation, perhaps more so than in the previous crypto winter. An environment of rock-bottom rates and ultra-accommodative monetary policy helped set the stage. With interest rates rising, as well as lack of trust in leveraged platforms, this deleveraging cycle has the effect of unwinding those prices much more rapidly than they rose, he said. Though traditional markets often rely on a slow and steady amount of leverage to grow, that effect is seemingly amplified in crypto because of how speculation concentrates in the sector. Now, regulators have been circling the sector, watching for signs of instability that might threaten their infant plans to rein in crypto. Even rules that were announced in the Northern Spring have had to change in the wake of Terra's collapse, with some jurisdictions preparing rules to ease the systemic impact of failed stablecoin systems. Any further crypto failures could ultimately pave the way for tougher rules, making a market rebound anytime soon even less likely. There may be some bear rallies, but I don't see a catalyst to reverse the cycle anytime soon, Griffin said. When the Nasdaq bubble burst, our research found that the smart investors got out first and sold as prices went down, whereas individuals bought all the way down and continually lost money. I hope history doesn't repeat itself, but it often does. And now, back around $1 trillion, the crypto market is only marginally above the approximately $830 billion mark that it reached in early 2018 before the last winter set in, spurring a downdraft that sent the market to as low as $100 billion at its depths, according to CoinMarketCap data. Then digital assets were the playground of dedicated retail investors and a select number of crypto-focused funds. This time around, the sector has built a broader appeal to both mum and dad investors and hedge fund titans alike, causing regulators to frequently intervene with statements warning consumers of the risks of trading such assets. And one infamous and now banned advert on London Transport Network read in late 2020, "If you're seeing Bitcoin on a bus, it's time to buy." Unlike crypto's early believers, mass adoption means most investors now view crypto as just another asset class and treat it in much the same way as the rest of their portfolio. That makes crypto prices more correlated to everything else, like technology stocks. Unfortunately, that doesn't make most crypto bets any less complex to understand. Though most of the financial world is taking a beating in 2022, the recent crypto market crash was amplified by its experimental and speculative nature, wiping out small-town traders who stuck their life savings in untested projects like Terra with little recourse. And the sector's hype machine is blaring louder than ever, utilizing tools like Twitter and Reddit that have been strengthened by new generations of crypto acolytes. Exchanges have also done their part with FTX, Binance, and Crypto.com, all spending on marketing and high-profile sponsorships. And many retail investors are lost. They just followed what they read in the newspapers. That's a mistake. Before the previous crypto winter, many startups had used initial coin offerings or ICOs to raise capital by issuing their own tokens to investors. They suffered when coin prices came crashing down because they had kept most of their value in that same pool of assets, plus Ether. And it worsened when regulators started to crack down on ICOs as akin to offering unregistered securities to investors. This time around, the funding landscape is vastly different. Many startups born out of the last freeze, such as non-fungible tokens and gaming platform Dapper Labs, have sought out venture capital funding as a more traditional route to raising cash. Behemoths like Andreessen Horowitz and Siliqua Capital collectively plunged almost $43 billion into the sector since late 2020, when the last bull market began, according to data from PitchBook. This means that instead of relying on crypto wealth, some of its biggest players actually have vast reserves of hard currency stored to get them through the blizzard as they work on growing new blockchains or building decentralized media platforms. On the other hand, the recent end of the bull market means they're now spending their cash much faster than it's been coming in. This month, Coinbase, Crypto.com, Germany Trust, and BlockFi are among the crypto companies that have announced swathes of layoffs, citing the general macroeconomic downturn for derailing their previously ever-expanding plans. Coinbase, which had hired about 1,200 people this year alone, is now laying off as many employees in an 18% cut of its workforce. But thanks to the heights crypto reached in the last boom, there's still a great amount of earmarked funds sloshing around Silicon Valley's coffers compared to previous seasons. Andreessen alumni Kate Hahn debuted her $1.5 billion crypto fund in March, while Coinbase co-founder Matt Hwang launched a $2.5 billion vehicle in November. And while VCs might be more careful now about where they are putting their cash, it's still got to be spent somewhere. None of these companies become mature for many years, said Alston Zecker, partner at 8 Roads. We've been spoiled over the last couple of years of seeing businesses get these amazing up rounds after 6 or 9 months. As the tide goes out, there's going to be a lot of people who are found to be naked. And also, crypto assets that lured investors of colour with the promise of quick wealth are now in free fall, threatening to widen existing inequalities in financial markets. And note the disproportionate impact. In a US survey in June from business intelligence firm Morning Consult, more than 4,400 adults, about a quarter of Black and Hispanic respondents said they owned or held cryptocurrencies, compared with just 17% of their white counterparts, according to that report. That implies a larger proportion of investors of colour will be hurt by the crypto rout, which has wiped away the $2 trillion in market value since the last fall. Black households are nearly 6 times more likely to be under or unbanked than their white counterparts, and are more frequently denied mortgages to own a home, which has long been viewed as the key to financial success and security. That's created stark inequalities, with the typical white household having $182,200 in family wealth, compared to $24,100 among Black families and $36,100 for Hispanic families, according to a 2019 survey from the Federal Reserve. Enter crypto, which has been hailed as a decentralized asset with the power to democratize asset to money and financial services, and has proven to be particularly attractive to investors from minority groups who have faced barriers to building wealth from traditional financial institutions, including banks, according to Charlotte Pripico, and financial service analyst for Morning Consult. The barrier to entry for crypto is lower, she said. Black consumers in particular see crypto as an opportunity to build wealth outside of a traditional system that has not served them well historically. US adults who own digital tokens believe crypto would help them get rich quick. 63% of crypto holders across ethnicities said making money was a major reason for holding digital assets. Investors piled in, enticed by tales of overnight crypto millionaires and endorsements from celebrity influencers like Kim Kardashian and Elon Musk. That helped take crypto mainstream, encouraging its use from Wall Street to Main Street, with more than 15% adoption among consumers, according to Morning Consult. Crypto has become such a cultural phenomenon. There's a fear of missing out among consumers. Wary of stock markets, nearly 40% of young black investors eagerly invested in digital assets, ranking crypto as the best investment choice, according to an April survey from Ariel Investments and Charles Schwab. Now, a larger proportion of them are exposed to an intensifying slump, with the largest cryptocurrencies plummeting by 65% in 2022 alone. A larger share of exposure to digital assets means the downturn is inflicting more pain for black and Hispanic investors who are less likely to have the financial resources to absorb the losses. 43% of black adults and 40% of Hispanic adults had a family income below $25,000 in 2021, at least twice the rate among white and Asian adults, according to Federal Reserve data. And crypto's slide is also threatening to compound financial troubles for black and Hispanic households that face the fastest rate of inflation than the national average, again, according to New York Fed data. The declines could also spell significant losses for lower income investors, with 42% of crypto holders reporting a household income below $50,000, according to Morning Consult. That said, lower income cryptocurrency owners were more likely than their higher income counterparts to believe digital assets are the future of money. This all gets back to who in our country has traditionally had access to money, Princico explained. Through this data, they're expressing a hope that there is a future in which they have access to their money in ways that are cheaper and more accessible. Now, I haven't seen any demographic surveys in Australia, but my suggestion would be that we also have the same demographic skews. Those with less savings and assets, perhaps without property, will be thinking that crypto is a good alternative. And it could well be that many of those will also lose their shirts in the process. So my belief is that whilst the underlying blockchain technologies will have future purpose and utility, the current wave of crypto is now turning. And it is unlikely that we're going to see a spring anytime soon. So for those who haven't yet looked at crypto, be careful, be very careful just now. There are really no bargains. And for those who locked in early and are seeing their investments devalue, well, just remember what happened through the global financial crisis in the major financial markets. Contagion can spread, the value of assets can fall, and shirts can be lost. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.